Good afternoon, everyone, and Happy New Year. Thanks for joining us for our first monthly international market update for 2025. Audio em português também estará disponível. I am Niraj Patel, the Chief Equity Strategist at Itaú, and I'm excited to welcome Torsten Slok from Apollo Management to discuss his thoughts as we start 2025. Apollo Global Management is a great partner of ours at Itaú. Apollo has over 500 billion in assets. They are primarily focused on private markets, but have strategies across public and private markets, and have an extremely impressive track record. I'm a big fan of Torsten's research, so for me, this is a great honor to have him join us. I love reading his blog, The Daily Spark, which has very insightful data each day, and love his in-depth research and podcasts. As a background, Torsten is a partner and the chief economist at Apollo. Prior to that, he was at the sell side and also spent time at the OECD and the IMF. Welcome, Torsten.
Thank you so much, Niraj. Thank you so much for having us.
So we wanted to touch on three different parts of your outlook: economics, politics, and markets. Very easy and simple topics. Since you came out with your 2025 Outlook piece and risks to the global markets in December of last year, many things have actually moved in the direction of your views. Back then, you thought the market was pricing in too many Fed cuts for 2025, and you even had a 40% chance that the Fed could raise rates. You recently highlighted in your blog that the US economy seems to be reaccelerating. When you look at the data currently, how many cuts do you think we will see, and has your probability of a hike changed?
Yeah. So we expect that the Fed will not cut interest rates in 2025. The backdrop is the following, namely that growth for the last 2.5 years since the Federal Reserve began to raise interest rates has been very strong, much stronger than what people expected. And the problem is, of course, that the Federal Reserve began to raise interest rates in August of 2022. And despite the Federal Reserve raising interest rates, the US economy has continued to do really well. And there are three reasons why economic growth has continued to be so strong. First of all, when the Fed raised interest rates, consumers were not impacted much by interest rates going up. The reason was that consumers have locked in low interest rates on their mortgages. Specifically in the United States, 95% of mortgages are 30-year fixed interest rate. This means that when the Fed raises interest rates, it basically has very little impact on the economy, because the vast majority of mortgages are locked in at low interest rates. As a result, consumers were not impacted much negatively from the Federal Reserve raising interest rates. Second, the US has also a very important data center boom. We don't have a data center boom in Germany. We don't have a data center boom in France. We don't have a data center boom in the UK. We don't have a data center boom in Brazil. It really is quite unique that we have a data center boom in the United States. In the United States, there are 6,000 data centers, more than all other countries in the world combined. And that data center boom is the second reason why economic growth has been so strong. And third and finally, the US also has very strong fiscal policy. The CHIPS Act, the Inflation Reduction Act, the Infrastructure Act, these policies were put in place by Biden. They were tailwinds to economic growth for the last 2 years. So in conclusion, what is the outlook for 2025, and why do we expect that the Fed will not cut interest rates this year? Is because we already have strong GDP growth because of less interest rate sensitivity, because of an AI and data center boom, and because of fiscal policy. And if I now add Trump policies on top of that, that brings us to the conclusion that Trump policies, if you put tariffs on products coming into the US, if you restrict immigration and do deportations, this will all be boosting inflation. So in conclusion, the reason why we don't expect Fed cuts this year is because we already have a strong economy, and adding Trump policies on top of that, that brings us to the risk is that inflation may begin to move higher and GDP growth may begin to move higher.
Right. And then in terms of the probability of a potential hike, I think you said maybe there's a 40% probability.
As you said, 40% is still the most likely scenario. In other words, the baseline is still that the Fed will not do anything this year. But we are watching very carefully, including yesterday, the executive orders and what Trump has been talking about. Because if Trump does a lot on tariffs, if he does a lot on deportations and immigration, and if he also cuts corporate taxes for domestic manufacturers, as he's been talking about, all this would be lifting inflation.
Great. And that's a good segue for the next question around, the interest rate sensitivity that you discussed, right? The U.S. seems to be less interest rate sensitive. You talked in your risks piece that the 10-year yield could get to 5% this year. We almost got there a week ago. And I'm curious if you think there's a tipping point. Let's say rates get to a certain level. Do you think it could slow down what seems to be an unstoppable market or economy? Curious how you think about, is 5% enough, 5.5%, 6%? Where is it going to then start to impact growth in the U.S., you think?
Yeah, so one way of answering that question is to look at the interest rate sensitive components of GDP. In other words, the parts of the economy that are most sensitive to interest rates going up. And those parts are in particular the housing market. The housing market is actually slowing, but the housing market only makes up around 4 or 5% of GDP. So it's actually relatively small, but it is a very fluctuating part, and it has been slowing down as a result of interest rates moving higher. It has not been slowing down as much as you would have expected because the supply of homes for sale has been very low. Why has the supply of homes for sale been low? Because consumers locked in low interest rates and were unwilling to move. And if people are unwilling to move, that means that the supply of homes on the market has been going down. So we've had this fairly unusual situation that demand in the housing market has been going down because interest rates were going up, but supply has also been going down. So as a consequence, yes, the housing component of GDP has been weakening a little bit, but not that much, meaning the economy is less sensitive when interest rates are going up, and therefore housing has been less sensitive relative to what would have been expected. A second part of the economy that's sensitive when interest rates go up is, of course, business spending. But business spending has been driven a lot by AI investments, and AI investments are also less sensitive to interest rates going up. And finally, for consumers, as we just talked about, given consumers have locked in low interest rates at very low levels during the pandemic, that also means that consumers have been less sensitive. So taken together, the answer to your question is that long-term interest rates can probably go up, in our view, to closer to 5.5%, 6% before something breaks, simply because the tailwinds to housing, the tailwinds to AI and business spending, and the tailwinds to consumer spending have been very strong. And if I add Trump policies, again, potentially tax cuts to corporates, maybe even tax cuts to consumers, then I come to the conclusion that there is still more upside risk for interest rates in the long end to move higher.
Right. And then this is obviously a very nebulous topic, but neutral rate comes up a lot. And I think you've discussed how you think the neutral rate is more, closer to 4.5%. The Fed talks about 3%. I think you even said the Fed will stop talking about neutral rates or should maybe stop talking about it because it seems like a distraction. If we were to look, let's say, beyond this year, there's no cuts in your forecast this year. How is the path beyond that to the neutral rate, and what does the Fed do? Because it seems like the Fed still is anchored on this 3% path, which could end up, causing growth and inflation to pick up if they decide to cut towards that neutral rate. So I'm curious how you think about the path after this year in terms of rates and this neutral rate discussion.
Yeah, this is very, very important because the Fed needs to have some idea about where short-term interest rates are going. And exactly as you're saying, the concept and the way that they have talked about this is the neutral interest rate, or in fancy language, as you and I talk about often, this is also, some people call this R star, which is the neutral interest rate, which is basically the level of interest rates in the economy where monetary policy, meaning Fed funds rate, is not restrictive and is not accommodating. In other words, that's exactly when the economy is in balance. And Fed working papers have been quantifying that the level of the Fed fund rate we're going to is around 3%. The problem with that is that if today, remember, the Fed funds rate is about 4.25. So if it were true that we're going to 3, well, then 4.25 is above 3. That means that the economy should be slowing down. That means that GDP growth should be slowing down. Consumer spending should be slowing down, because if it were true that in the long run we're going to 3 and today we're at 4, well, then we should be seeing the economy slowing in a fairly significant way. But that is simply not what we're seeing. GDP growth remains very strong. We just got a very strong employment report. All those things combined with still inflation at around 3% tells us that maybe the neutral rate is not as low as 3. And we have been saying, exactly as you highlighted, that maybe it's closer to something more like 4.5. And if that's the case, maybe we are already at neutral, and therefore there is no need for additional Fed cuts. And instead, there might even be a risk that the Fed may have to hike interest rates later this year. So let me back up and talk about what this means for asset allocation and for investing. It basically means interest rates in the short end of the yield curve are going to stay higher because the economy is likely going to be stronger. In the long end of the yield curve, that also means long-term interest rates will be higher because the economy is stronger. And also on top of that, we have a lot of fiscal problems here in the United States that may also be putting upward pressure on long-term interest rates. So the conclusion is, if long-term interest rates are higher for longer, that of course means that bonds, private credit, in fixed income generally, you can cut some coupons, you can get some returns that are very interesting relative to what you have seen for the period from 2008 to 2022, when interest rates, of course, were close to 0.
Right. And maybe, you've discussed Trump policies. We had the inauguration yesterday. I think many of us watched. There was a lot of activity after the inauguration with the signing of executive orders. I think you've discussed tariffs. Markets got a little excited yesterday because it seemed like there was no day one tariffs on China, but then Trump came out and said that maybe on February 1st there would be tariffs against Canada and Canada and Mexico of 25%. What are you expecting over the next few weeks and regards to tariffs, immigration policy, and then as a follow-up, when does that really matter for the economy in terms of inflation and other things?
Yeah, so the starting point, as we just talked about, is that the economy is already strong. So it is very important question you're asking, namely, if the economy is already strong, then what is Trump then going to do? Is he going to make it even stronger? Or is he going to not make it stronger? He's just going to do nothing. One way to look at that, and forgive me now for sharing my screen very briefly here, is, of course, to look at what betting markets are saying exactly about this question of what will Trump actually do. And betting markets at the moment, so this is Polymarket. I know that there are other Kalshi, there are other various betting markets you can look at, but they happen to have a question at the moment. You can put money on this, namely Trump imposes 25% tariffs on Canada and Mexico before March. And you can see that the market is only assigning a 30% chance to that being the case. In other words, the market is actually saying that Trump is bluffing. The market is saying that Trump will not put 25% tariffs on Canada and on Mexico. At least the probability of that is lower than 50. So if that's the case, that at least gives some reasons to be, from a market perspective, I have no political views. I'm just a bean counter trying to figure out what will happen in the future. But if the market is saying we might not get tariffs on Canada and Mexico, well, the good news then is, at least from a rates and in markets perspective, is that then we may not get that lift in inflation that would be coming with imposing tariffs on Canada and Mexico. So the conclusion to your question is, it becomes really, really important for you and for us and for everyone to follow and try to figure out what are Trump policies actually going to consist of, and will he actually do what he's saying on deportation, on immigration, on tariffs to Mexico, tariffs on Brazil, tariffs on Europe, Denmark, everyone, or will he not do any of those things? My personal view is I think he will do some of those things, So I still worry about that inflation today is 3 and it's supposed to be 2. So if inflation is 3 and it's supposed to be 2, and now we have a risk that Trump might either put tariffs on, restrict immigration, lower corporate taxes, all things that argue for inflation to move higher. And that's the reason why we continue to worry more about the upside risks to the economic outlook and inflation than the downside risks.
Makes sense. I think all of us are going to be following every word that he has to say or the administration has to say, but also what does he actually sign into law? Because as you mentioned, he could say a lot of things, but ultimately what he does is what's going to matter, and not what he's
Absolutely.
saying. And so I think we'll have to wait to see how that progresses. Maybe to take a step back outside of the U.S., we focus a lot on the U.S., but you talked about the U.S. charting its own a path. Recently, in one of your blog posts, you had a chart showing the performance of Chinese yields. And if you look, maybe in many ways, China's charting its own path in a different direction. And we get this question a lot. The if you look at Chinese interest rates and global rates, there's this gap that's widened. And so, curious how you think about can this persist? Do you think it can help to cap interest rates in the U.S.? Maybe it puts downward pressure because of the impact or influence from Chinese rates. And so, how does this play out in your mind?
Yeah, this is very important also. And I know this is indeed very important also for Brazil, because how China is doing, of course, plays a very critical role for many economies, including Brazil, but also other economies, in particular, of course, in Southeast Asia. And the problem in China is the following 3 things. The problem in China is that they have some demographic headwinds that are very, very significant. Remember, China used to have a one-child policy. And according to the United Nations, the workforce in China will shrink over the next 10 years from 1 billion to 900 million people. That means that we will have 100 million people fewer working in factories, 100 million people fewer paying taxes, and also 100 million people fewer who are in the workforce, who therefore have certain housing demands. So the first conclusion is China is facing some significant headwinds for demographic reasons because the one-child policy is catching up to where we are today. Secondly, because of those demographic problems and because of more general problems in the Chinese economy, we also have a bursting housing bubble. And what I mean by a bursting housing bubble is that existing home prices are down 9%, new home prices are down 6%. And when home prices go down, we know that that creates a lot of problems, like it did in the financial system in the US in 2008. And because of that, we simply have a situation where the housing market in China is exactly disinflating. And this is also creating problems for the Chinese economy. And finally, China is also engaged in a trade war. They're engaged with a trade war, not only with the US, but also with a trade war with Europe. And because of that, that also means that China has some headwinds to growth because the gates are going up, meaning for exports out of China, not only to the US, but also to Europe. Europe, until recently, was allowing imports of BYD cars. Then suddenly, Christian Lindner, the finance minister in Germany, he certainly said, no, we can no longer allow this because Volkswagen is now going to close some factories. So let's now put up also tariffs, 35% on BYD cars coming into Europe. And suddenly, China is no longer able to export to Europe either. So that's why, Niraj, to your question, that Chinese interest rates have been coming down because Chinese growth is not doing very well. And that is very unique for China, that they have these unique reasons why growth is slowing, whereas the US has some unique reasons why growth is accelerating. So it's highly unusual that the business cycle is so strong in the US and the business cycle is so weak in China. So for that reason, I still think interest rates in China will continue to decline. I think the Chinese exchange rate will continue to decline. And I think also, therefore, Chinese stock markets continue to look relatively unattractive simply because the business cycle outlook for China is unfortunately very weak. And that is unfortunately having some impacts on Brazil also because that lowers demand for iron ore, that lowers demand for commodities, and therefore also causes some negative impacts on the Brazilian economy.
Great. And just as a reminder, if anyone has any questions, feel free. You could put it in the chat, and we see it. I see a couple questions already coming in. And maybe to continue on the China piece, in previous cycles, if you go back, 2004, 14, 15, when China was weak, it spilled over to other markets, right? Europe is, as you mentioned, very tight. It also impacted, U.S. Asset prices. So do you think that this could start to impact others? You mentioned Brazil with the connection with iron ore and commodities, but how do you think about it? It seems like in many cases, and again, this is maybe more U.S. centric. U.S. investors are not paying as much attention to this and saying it's it's a China problem. But I'm curious if you think this could spill over to other markets and where and how it could impact other markets.
I think that is unfortunately the case, namely those who export to China are going to get negatively impacted. We are already seeing this in a significant way, for example, in Germany. Germany has been impacted negatively by the slowdown in China because Germany essentially, in my opinion, produces the assembly line for the Chinese economy. So if the Chinese economy is slowing down and it doesn't have a need for producing manufacturing capacity anymore to the same degree, then that means that we will continue to see the China slowdown have negative consequences, not only for Thailand, Indonesia, Vietnam, Laos, the neighboring countries, but also for the commodity exporters such as Brazil. But it will unfortunately also have negative impact on Europe because Europe has been exporting historically, especially Germany, to China. The interesting thing to your question is that it actually has a relatively limited, if basically no impact on the US, because the US is not particularly integrated with the Chinese economy. So that means that for that reason, the US economy has continued to do well, while the Chinese economy has continued to not do well.
Great. And then you touched on markets a little bit, and maybe to kind of drill down on the view around yields. You said it's a good time to take advantage of yields. If you go back, post financial crisis till COVID, yields were very low, and we actually agree. We have an overweight right now in U.S. fixed income as part of our asset allocation. So you also mentioned private credit. So maybe you can expand on that. And I guess one part that I think sometimes fixed income investors can make money when you go through a cutting cycle, right? Which is maybe more instant payoff, because if you can get the whole yield curve to go down in the next X quarters by 100 basis points, then okay, you can get paid on the appreciation of your fixed income investments. But this seems like more it's you get to enjoy the carry for many years and kind of take advantage of the yields that are out there. So I'm curious how you think about this. You mentioned previous, regimes and cycles. If you can expand on your views around fixed income as an asset class.
Yeah, so I think what is very interesting about the current situation is this expectation that interest rates will stay higher for longer. So let me just share my screen here again and show you another chart that is exactly pointing to what we're talking about here. So this picture here shows you the green line is the Fed funds rate. The dotted line is SOFR futures. So this is the market's expectation to where will short-term interest rates be over the next 5 years. And you can see that the environment we're facing here at the moment is very different when you think about the difference between where we were from 2008 to 2022, where interest rates were zero. Now interest rates for the next 5 years are expected to be 4%. So if this is the case, my first response would be, why not take this opportunity and cut some coupons and benefit from the level of interest rates staying higher at a permanently higher level relative to where we were from 2008 to 2022. And if you add a spread on top of this in private credit, it could be in asset-backed finance, it could also be in public credit, it could be in mortgages, it could be consumer ABS, auto loans, credit cards. A lot of things will pay you an even higher level of yield as a spread on top of the base rate staying at around 4%. So I view the current outlook where the economy is strong. We have some fiscal challenges in the long end of the yield curve. All those things combined argue for the entire yield curve potentially having higher levels of yield for the next several years. And if you have higher levels for yields, yes, I understand, and I know this is your world, but if I look at the trailing PE ratio for the top 10 companies by market cap in the S&P 500, look at the trailing PE ratio for Tesla at the moment. It's 187. Normally, for the last 50 years, the PE ratio for the S&P 500 has been 16. And now you suddenly have a PE ratio that is really, really high for Tesla. Even NVIDIA, 53. That's a very high PE ratio. Amazon, 45. Yes, I think these companies could still be interesting, but why not? And I love the adrenaline rush that comes with investing in these companies, but why not just cut some coupons? Why not just benefit from the level of yield being higher and benefit from that in private credit, benefit from that in public fixed income, benefit from that by saying, hey, I can get some really interesting yield levels, some really interesting cash flows as an investor that I have just not been able to for many, many years. So yes, I do still think that the stock market is always interesting and exciting, but I am actually now having some really nice alternatives to the stock market where the level of yields is elevated. So that would be my recommendation, to look at that very carefully and keep in mind that, yes, I can actually get a higher return in fixed income at the moment.
Yeah, and it's also, I mean, probably risk adjusted in certain parts of fixed income. You're not taking as much risk and you're getting good yield, so it makes sense when you look at it that way, and you can take advantage and lock in some yields for a few years at the levels that you showed on that chart. Completely makes sense to take advantage of that. And since you kind of went down the path on equities, I think your work, you highlighted some risk. You had recently something showing the amount of concentration that's in the S&P 500, which the multiples across some of those stocks, they're high concentration in the S&P. You mentioned in one of your pieces the revenues that come from abroad where economies are weaker, like Europe. But I'm curious, where do you maybe see, if you see any opportunities within equities, if you were looking for anything, or maybe it's more fixed income focused, but figured I'd ask you that question to see what your thoughts
Yeah,
are.
this is very important. So I just told you, and I know you know this better than me, but exactly that 40% of the S&P is the Magnificent Seven, or the top 10 stocks in the S&P 500. This goes completely against page 1 in my finance textbooks, which tells me to diversify. You are not diversified if you buy the S&P 500 today, because the S&P 500 is mainly driven essentially by NVIDIA. So therefore, given NVIDIA and the top 10 stocks have such a big weight, the concentration is just quite extreme. And returns for the last 2 years have also been driven quite extremely by the Magnificent Seven, or the 10 biggest tech companies. Likewise, if I then think about that from a broader perspective, that means that I just think that the top 10 biggest companies are too expensive from a valuation perspective. And I don't want to hang my entire savings on the view that NVIDIA will succeed or not succeed. It completely flies against the recommendation to be diversified. The problem in the other end is that small cap, you could say, well, small cap will always outperform other things. Well, but the problem with small cap at the moment is that for the Russell 2000, that's the index for small cap stocks, 41% of companies in the Russell 2000 have negative earnings. And if 41% of the Russell 2000 have negative earnings, this is also a problem when interest rates are higher for longer. Because interest rates higher for longer means that small companies are not able to pay for their debt servicing costs. So that brings you to the answer to your question, that if I have to be in equities in the public space, then I really like S&P 400. And S&P 400 are the mid-market, mid-cap companies that have solid earnings, but are not too expensive. So that's why I would recommend that if you have to be in public equities, I would be buying the S&P 400, because I think that looks attractive from a valuation perspective, and that looks also attractive because they have earnings and therefore are able to pay for their debt servicing costs when interest rates are higher for longer.
Got it. Makes sense. Thanks for that. And you mentioned NVIDIA, and I think the top risk on your risks for 2025 was, and I know some of this is it's tough to predict, which is why you say these are risks, right? And one of the risks was NVIDIA could disappoint inflated earnings, and to be fair, NVIDIA has actually been relatively flat. If you go back to June of last year, it's kind of at the same level. So maybe some of this is also, as I mentioned at the beginning of the conversation, some of your thoughts for the outlook have come to fruition maybe early. But I'm curious, since NVIDIA is such a big driver of the S&P, and then AI is such a huge theme, is that I'm curious if you can expand on that. NVIDIA disappointing as one of your risks for this year.
Yep. I didn't know before you told me recently that exactly I hadn't paid attention to that NVIDIA had been at the same level since June of last year. But it is very telling for the current situation, namely that essentially a significant part of returns in the S&P for the last 2 years. Of course, it's done really well, and it's good for all of us who have some money in the S&P 500. But at some point, you need to ask yourself the question, well, if NVIDIA now is the main driver, am I willing to bet my investment in the S&P 500 on NVIDIA doing even better than where they're priced at the moment? And it may be they will do better, maybe, maybe not. But my finance textbook would tell me that I need to diversify. So I love the adrenaline rush that comes with looking on a Wednesday afternoon. Is NVIDIA earnings, are they good? Are they bad? What happened? Did they sell enough chips? Are the racks overheating? All these discussions we can have. Did orders only come from a few customers? But I end up saying, well, yes, the AI story, I still think it's good. I still like the AI story. I think it will succeed in many ways. But is it only NVIDIA that will be the AI story? And if NVIDIA evaluations are so high as they are today, maybe I should be broadening out my AI investments to other things if I want to be exposed to AI. So yes, I almost consider this as part of your normal portfolio rebalancing. When something grows bigger and bigger and bigger, as NVIDIA has been in everyone's asset allocation, at some point you need to ask yourself the question, okay, do I now have too much exposure in my pie chart to NVIDIA? And therefore, maybe should I begin to think about getting exposure to other investments? Could it be in equities, could be in fixed income, to make sure that I'm not overexposed to NVIDIA as such. So I don't have a strong view. I do happen to believe that AI is very expensive. I do believe that AI is very different from the internet in the 1990s, where the internet was giving you free information, which obviously made everyone more productive. This was basically costless. There was no cost. It was totally free, and it did help everyone. Whereas now AI is not free. Copilot, ChatGPT, various versions of agents, it becomes very expensive, something you need to subscribe to. And yes, it will probably help on productivity, but I don't think it will be the same boost to productivity that we saw in the 1990s, when suddenly everyone was able to communicate for free and sharing information for free. That made us all more productive immediately, because now it costs money, it's expensive, it requires education, it requires a lot of manpower. And I do think those reasons are important reasons why the AI boom we're seeing at the moment will probably give less productivity gains relative to what we saw in the 1990s.
Right. And I started off a conversation saying that three easy topics: politics, economics, and markets. And we got a question from a client, which is also very easy. What do you think about Brazil? You mentioned Brazil in the context of its connection to China, but for our audience, it'd be great to hear your thoughts on whether it's the Brazilian economy, Brazilian real, currency, markets. What are your views around Brazil? It would be helpful to hear your thoughts.
Yeah, so I would say, at least as an outsider, the problem is that Brazil has, of course, faced a number of external things that are very important for the Brazilian economy. And those things, of course, are not only has China slowed down, but you also have, unfortunately for Brazil, that US interest rates continue to be very high. And when US interest rates continue to be high, this has, of course, been a very important reason why the real has depreciated so much. So the real, of course, went up all the way to 620. Now it's come down closer to 6 more recently. But I think that on its own, those two headwinds to the Brazilian outlook, namely US interest rates staying high, which by definition, the textbook in financial markets tells you that if US interest rates are high, it causes a lot of problems for emerging markets, not only for Brazil, simply because suddenly US assets and US yields are suddenly very interesting relative to the returns you can get in many emerging markets. So the double whammy of both high interest rates in the US and China slowing down have unfortunately been and continues to be significant headwinds to the Brazilian outlook. I will not venture into discussing Brazilian politics. You all know this much better than me. I will just say, as an outsider, that it, of course, is also clear that some of the politics that we've had more recently has probably also played a role in some of the challenges that the Brazilian economy has been through. But I would say, for me to become, as a foreigner, very bullish on buying Brazilian stocks buying Brazilian fixed income, I will need to see the Fed cutting meaningfully and interest rates going down meaningfully in the US, because that will, in relative terms, make Brazil more attractive. And I will also need to see some stabilization of the slowdown in China. And that is not what we're seeing at the moment. And that's why also iron ore and the commodity sector in Brazil continues to still face some headwinds. So the conclusion is, I am still, unfortunately, somewhat worried about the outlook for Brazil, because US interest rates are higher for longer and China is unfortunately still slowing down.
Great, thank you. And to keep going with the questions that we're getting from the audience, one of the questions, and I think you kind of addressed this, but just feel free to add any additional comments. I think you talked about how certain AI or tech stocks seem expensive. The question is, do you think there's a tech bubble? What's your perception around that? And again, never an easy answer to that question, but curious what your thoughts around that is.
Yeah, so I actually do think that there is a tech bubble. I would not have said this 2 years ago, because I think that there is a lot of promise in AI. And I absolutely think that a lot of these companies will be benefiting from a Trump administration. There were worries under the previous administration about privacy for Meta, for Alphabet, for various of the tech companies in terms of what was coming if Harris had been winning the election. But with Trump coming in, and in particular, as we saw yesterday, with Mark Zuckerberg and Elon Musk close to Trump, and also, of course, Bezos, I still think that the issue continues to be that, yes, tech companies, they do have a lot of promise, but I think that valuations have just gone up to levels where I think that there are so many other things that I can be investing in. And those things could be, again, in public markets, it could be S&P 400. But in private markets, you can certainly also buy private credit. You can buy various versions of equity in private equity or hybrid value or various other strategies that will give you returns that will be still quite solid, especially benefiting from the level of yields being higher, but without the challenge of, excuse me, having a hard time falling asleep at night because am I too overexposed to NVIDIA? Am I too overexposed to Tesla, to Amazon, to Meta? So I would recommend going more underweight the tech stocks. Yes, the benefits have been nice and the returns have been nice for the last few years, but I think now is a good time to begin to go and look somewhere else, especially again with the backdrop of yield levels in fixed income giving me a very nice cash flow every single month.
Great. And then one of the questions around that is, what are other options of AI? It might not be something that's your expertise, because then this gets into more kind of specifics around stocks and sectors. But I'm throwing it out there if you have other options within AI. But we can also go on to the next question if that's difficult to answer.
So the sectors, of course, that are going to benefit when interest rates are higher for longer is, of course, that the economy is doing better for longer. So that means that cyclicals should be doing well, financials should be doing well. I think consumer discretionary, in particular for high-income households, should continue to do well. Let me just show you one other chart here, and forgive me for pulling up all these different charts, but there's one chart also that is important when we think about the outlook for the US economy, and that's this one here. This shows you savings across the income distribution. Specifically, this shows you savings for people who make less than $25,000 a year in the United States. The green bar shows you what did they cumulatively as a group have in savings in 2019, and what do they have in savings today in the red bar. And you can see that this group of low-income households, they basically are out of excess savings, and this is not even inflation adjusted. So if you adjust for inflation, the red bar is even lower. So one important conclusion is that low-income households have no excess savings left. Compare that with high-income households. These are households that make, in this case, the 20% of incomes at the top, they account for 40% of consumer spending. And the rich and high-income households, look at what their savings have been doing. Today, in the red bar, their savings are higher than where it was in 2019, literally by trillions of dollars. And look at it more recently. It's been going up. Why has that been going up? Because if you are a high-income household, you probably own the S&P 500, you probably own your home, and you probably also own private credit or fixed income in some form. And the cash flow you get in fixed income today is better than it's been forever, or at least in decades in the United States, simply because interest rates higher for longer is paying people more who own bonds. So in that sense, not only are asset prices up, but cash flows are also up. So that's another way of saying this chart here is a reason to be optimistic on high-end consumers because they still have plenty of savings left. And there are, of course, reasons to be more worried about low-end consumers because low-end consumers do not have savings left. So that's another way of saying, if you ask me about sectors and individual names without mentioning any company names, I would say companies that cater to high-income households in the US continue to actually look quite attractive, or put in very plain English. That's exactly, in my view, the reason why the Ferrari stock price is at all-time highs and the Dollar General stock price is at all-time lows, because you have this bifurcation in the outlook for the consumer as a function of whether you're talking about high-end consumers relative to low-income consumers. And that's why when you ask me what sectors, particular, for example, of consumer, do I like, and I do like those that cater to discretionary spending for high-income and middle-income households, I think they will continue to do well. Likewise, if I look also at, again, the backdrop of China slowing down, that means that mining materials should probably continue to be challenged simply because commodity prices have been under some downward pressure. And energy, we've seen slightly surprising energy prices go up because the US economy is doing so well. So I would also say energy could probably also be interesting in different ways. But across the S&P 500, I think there are many things that one can do, again, with this backdrop of a weak Chinese economy, strong US economy, and interest rates higher for longer.
Great. Then maybe to continue with questions, one of the questions around infrastructure. I think politicians in the U.S. and kind of everywhere like to talk about infrastructure. AI requires a lot of infrastructure, whether it's data centers, power. I think private equity is also involved in infrastructure investments. So, wondering what you think about one of the questions is around infrastructure-related investments, and I know that's a pretty broad asset class, but considering the question, what are your thoughts around that?
Yeah. So I think there are two dimensions to looking at infrastructure at the moment. I completely agree, and I think this is the main argument for why I am bullish and you should be optimistic on infrastructure. Namely, we need AI investments, we have a significant energy transition, we have politicians, especially in Europe, that are very supportive of infrastructure, and all those things combined mean that infrastructure will have some significant structural tailwinds that I think are the main reasons why infrastructure continues to be a good idea, because I would like a cash flow over the next 20 years. Infrastructure is a long-term investment. It will give me cash flows over the next 20 years. There'll be contractual obligations associated with that, and all that argues for infrastructure still doing well for a very long time, because there is a need to invest in infrastructure. We do that at Apollo, many others do that, and this continues to be a very strong theme and a very strong reason to be optimistic on the outlook for infrastructure. On the other hand, the problem is, as we spoke earlier, that interest rates are higher for longer. And if I have an asset that pays me a cash flow over the next 30 years, and suddenly interest rates are higher for longer, the net present value of that cash flow suddenly goes down, and it potentially goes down a lot because the cash flows are so long dated. So on the one hand, I like energy transition because of data centers, because of politicians, because of AI, because of energy and energy transition. But I'm still struggling a little bit with when rates are higher for longer, it is normally long dated cash flows that suffer the most. So that means that some parts of the infrastructure world has not been doing well, in particular those parts who do not make money. And that's why investing in infrastructure requires the question, do you have contractual obligations associated with this investment? Or are you just investing in something or buying something in the infrastructure supply chain that does not have cash flows associated with it for the next 20 years? So that's why, as an infrastructure investor, it becomes very important to think about it from the broader perspective of, are there cash flows? Will the bill be paid, to make sure that I, as an investor in infrastructure, get my cash flows back? And that's why interest rates higher for longer creates some special topics for infrastructure, to make sure that the sponsor or the investor in infrastructure actually invests in things that actually have cash flows associated with it.
Got it. So yeah, I think you have to be careful is the bottom line because you want to make
That's the
sure that
bottom line. I
there's
think politicians like it, and that's why I also like it. And I like AI, I like energy transition, I like data centers. But I think that the question to be asked for any infrastructure investment is, how sensitive are you if interest rates stay higher for longer? Are these assets you're investing in, do they have cash flows associated with them? And if the answer is yes, they have cash flows associated with them, then I would say, okay, then let's go ahead and do it. Because if they don't have cash flows associated with them, then interest rates higher for longer. We've seen this in windmill production. We've seen this in solar panels, in many parts of the renewable energy space, where you simply had production went down because there was no guarantee that people would be buying my solar panels or my windmills or my EVs or batteries or other renewable energy things, because there was no cash flow contractually associated with the investment.
great. We got a few questions around the fixed income side, since it's obviously an area that you like and you've addressed a few times. The questions are more around if there's particular parts of the curve, and again, this might be too technical. If there's anything around CLOs, and again, I think it's probably too technical because it's a
That's good.
specific.
Let's talk about it. I
Okay.
do think, importantly, that, as I said before, if I just pull up this chart again that I had with interest rates staying higher for longer, if interest rates are staying higher for longer, exactly to your question, Niraj, where in fixed income should I go? Well, if interest rates stay higher for longer, and this particularly hurts assets with weak revenues, weak cash flows, weak earnings, that means that by definition, I need to be up in quality. So that's another way of saying, in CLOs, I don't want to buy the mezzanine. I don't want to buy the subordinated debt. I want to buy AAA. I want to buy the top quality tranches, because that's where I get the best guarantee that when interest rates are higher for longer, I both benefit from a high level of yield, but I also have less risk exposure to credit risk. So that means be up in the waterfall, be first lien, senior secured, top of the capital structure, to make sure that you get the best protection at the high end, to make sure in CLOs in particular that it's AAA, it's the best part of the CLO that you're buying. Or put in more plain English, I would be buying the investment grade credit today rather than the high yield credit, because high yield is exactly characterized by having low interest coverage ratios, by having weak earnings. And if you have weak earnings and low interest coverage ratios, the consequence of that is that is going to be a problem for the credit if interest rates stay elevated for an extended period. So it opens up a much broader question of, is it today that's unusual? Or was it the periods from 2008 to 2022 that was unusual? And in my strong opinion is, it was 2008 to 2022 that was unusual. Today is the norm. And it was this period here that was unusual. We should be investing with exactly in mind and say, we want to have assets that have cash flows. We want to have assets that have earnings, to make sure that we get the best protection against the downside risks that come along with interest rates higher for longer.
And as a follow-up on that, credit spreads come up, and you mentioned, obviously getting a spread on top of the yield, but spreads are at some pretty tight levels depending on where you look. Wondering how you address that, because and again, there's so many different spread products and risks and levels, but curious how you think about the compressed levels of spreads and how to think about investing in those asset classes.
Yeah, and forgive me for sharing the screen again, but this is extremely important what you're saying. This is the beauty of having the Bloomberg screen and the sharing here together when we do it over Zoom. But have a look at this chart here. This is the white line on the right axis is the IG spread. You can see that's currently trading at 79 basis points down here in the corner. The orange line is the high yield spread. You can see the high yield spread is trading at 262 basis points. So now you're beginning to ask the question, okay, so if spreads are trading as tight as they have been in a long, long time, of course, the consequence is that this is, of course, a relatively unattractive environment to enter as an investor. Or let me put this differently, if I just share the chart again, that the risk, of course, is that, yes, I may be buying investment grade credit in, say, the white line, but if I buy something in the white line, well, then I'm buying it at very, very tight spreads. So you could certainly legitimately ask the question, well, I don't get much in reward for buying IG. So why should I be buying IG if it doesn't come with much return relative to the risk that I'm taking? And this is, of course, a very important question that even in high yield, you also do not get rewarded for taking the risk with a spread of only 262 basis points. So that's why I still think that the right way to look at this is therefore that we have to buy other fixed income that provide maybe a little bit more, take a little bit more risk in different dimensions, but generally in CLOs have good protection, in private credit have good protection, but make sure that it is up in quality, first lien, senior secured, top of the capital structure, to make sure that we have the best protection in the investments that we're making. So yes, hybrid is another way to look at, is it debt versus equity? Apollo happen to have hybrid products and like many others, but the conclusion is giving the flexibility to decide where am I investing on the debt or the equity side when you lend to companies to make sure that that protection comes at a low cost. So if you want to have high returns, you have to take some risk, but that risk again can be manageable, even if you look outside IG and high yield, which is what you see here.
Right. Those are most of the questions that I see from the audience. I mean, one question is around real estate, and I don't know, I think there's been a lot of wealth built up, and you mentioned the chart you showed before, the top income bracket in the U.S. has done well, partly because real estate values have gone up so much. What's your outlook on real estate? I mean, there's so many different parts. Obviously, housing is probably the one that everyone thinks about because consumers can tap their home equity, if they have some value in their home. So, your outlook for home maybe prices or from here, wondering what you think about the housing and real estate markets in the U.S.
Yeah, so I don't need to pull up the charts here, but the short answer is that housing, meaning residential housing, as we spoke a bit about earlier, still has a very low inventory of homes for sale. And when the inventory of homes for sale is low, that means that, yes, demand may be squashed a bit by high interest rates, but if the inventory of homes for sale also goes down, that means that home prices have actually still been going up around 5% for the last year. So we have not seen, despite what I would have expected, that when the Fed raises interest rates, I would have expected home prices to go down, but that's not what we've seen because of this low inventory of homes for sale. So the conclusion to your question is, I think residential real estate could actually continue to do well. I'm more worried about office and commercial real estate. Office and commercial real estate remains very unattractive because think about it the following way. If I build a skyscraper here in Manhattan, it will have a lifetime of 30 years, but it needs to be refinanced every 5 years. And if something needs to be refinanced every 5 years and I build a skyscraper in 2020, I wake up in 2025 and say, gee, I need to refinance this skyscraper at a lot higher interest rates, and the value per square foot for office is down 30% from the peak, which was in November 2021. That means that not only is the underlying value of my asset down, but my financing costs are also a lot higher. So that's the reason why every day you open the Wall Street Journal and Financial Times, that there's a lot of skyscrapers and office parks that are being sold at 60, 70, 80% discount. Why would anyone sell something at 70, 80% discount? Because they are saying when interest rates are higher for longer, then of course, commercial real estate will continue to do poorly. So higher for longer for interest rates is also telling us that commercial real estate remains, also multifamily, shopping malls remains very unattractive. And that's why, again, it becomes not only a function of whether you can service your debt, but it also becomes a function of when are you running into the maturity wall. And some asset classes, including commercial real estate, are running into the maturity wall quickly. And that's the main problem. Therefore, namely, that those asset classes will also continue to struggle. So generally speaking, I am quite worried about commercial real estate as an asset class, but I'm actually quite bullish overall on residential real estate because consumers have locked in interest rates for a long time, and we simply have not seen that in commercial real estate.
Interesting. Yeah, didn't know the dynamics around the refinancing around office and commercial real estate. So it makes it tough if the rate environment changes so quickly, and you have to make a forecast for 30 years, and now all of a sudden you're left with this big burden. So, and obviously the consumer in the U.S. took advantage of low rates in 2021, which has obviously underpinned a lot of the things that you mentioned in the beginning, part of the conversation of why the consumer has been able to keep spending despite the fact that rates have gone up as much as they have. So you can see why there's kind of a bifurcation in many parts of the U.S. economy. from some of these dynamics that you
Exactly.
mentioned. One other
Exactly.
question.
And interest rates. So let's summarize everything we have talked about for the last hour here, namely that interest rates going up, it has had an impact, but it has mainly had an impact on those who were interest rate sensitive. And those are exactly capital structures that were interest rate sensitive. Venture capital is extremely interest rate sensitive. Commercial real estate is interest rate sensitive. Low-end consumers are interest rate sensitive. And also low-rated in credit terms, corporates are interest rate sensitive. So those are the parts that have experienced more distress, whereas in the aggregate, in macro, we still have not seen those distresses spill over to become a macro problem. But we're watching and monitoring, of course, very carefully what's going on all these fronts for any worries that it might become such a big problem that eventually becomes a macroeconomic problem.
Got it. Well, that's probably a great way to end the conversation. It sounds like you're watching all these little pockets of areas where there might be some risk. So for those that haven't gone onto the Apollo website, Torsten's blog is open to everyone. It's a great resource, and we want to thank Apollo and Torsten for joining us. They're a great partner of ours at Itaú, and we look forward to future conversations. Thank you.
Thank you. Thanks so much, Niraj. Very nice to see you, and thanks very much, everyone, for joining.
Great. Have a great day.
This discussion is intended for informational purposes only. This is not investment research or investment advice, and no recommendation or financial advice is being given. This discussion does not take into account individual investment objectives, financial condition, or investor needs. The views and opinions expressed in this discussion may differ from the views and opinions of other departments or divisions of Itaú and its affiliates.